Welcome back from the break. We were discussing what is the fair value of an investment, which we have to put into the single financial statement of the parent. So we're not talking about valuing all the assets and liabilities at fair values to put in the consolidated financial statements. So we're in the first step. And I promised you that you can do a little case study where you could find out what is the fair value of the investment. And we will use the case study of Poland. Hello. Yes, Poland acquires Warsaw. The total shares are 200 million. So the consideration that Poland will give to the old shareholders is they will pay $25,470 via a bank transfer. Then Poland will issue 10,000 shares to the shareholders of Warsaw, each with a nominal value of $1 and a market value of $4. Then Poland issued 5,000 loan notes with 10% interest to the shareholders of Warsaw. Then $20,000 are to be paid 2 years after the date of acquisition. So the relevant market rate is 10%. And further amounts may be payable at a later date, subject to certain performance targets being met. So we're talking about some consideration, and that fair value of this consideration is $38,000. So at the acquisition date, Warsaw's net assets are $80,000. So what is required? I will put you into breakout rooms, and then you can discuss what is the fair value of the total consideration that Poland has given buying its investment in Warsaw, and prepare the necessary booking entries. Then determine the goodwill arising from that transaction. And also you should be able to show the subsequent accounting for the deferred consideration. And then please also show the subsequent accounting for the contingent consideration on the basis that the targets were not met. All right, so for requirements, so you have some time, and I will put you into the breakout rooms now. So welcome back. I hope you had some fun working on the facts and circumstances in the case study of Poland. You can see the facts and circumstances on this fact sheet. On the next slide, you see the form that you could use for the first question. First question was, what is the fair value of the consideration that Poland has given buying its investment in Warsaw? So when we look at all these elements, then a total of 125 will show up. So the easy thing was the amount of cash paid, and the second one was own shares. Well, the fair value is the market value. So $4 times 10,000 equals 40,000. The interest-bearing loan notes were at market, so we just take the nominal amount which has to be paid. And the interest is, of course, a cost for Poland in the following 2 periods. So we will not put that in here. Only if there was a difference in the market rates and the interest rate that would be used for the loan notes. If that would be the case, we would have to adjust the fair value of these loan notes. So in that case, the interest rate is at market. We just take the nominal amount. The deferred consideration, we have to pay, or Poland has to pay 20,000 in 2 years. So we have to discount that because there is no interest in that. So we have to deduct the 10% interest for the 2 years. And of course, after 1 year, we have to reallocate the interest. That means increase that deferred consideration by 10%. And in the next following year, and the second following year, we do the same. So after 2 years, increasing the liability by adding the interest, we have to pay 20,000, which would then be the obligation after 2 years. But first, we have to discount it for 2 years. So 16,000 is the fair value of a payment in 2 years' time. Then we look at the contingent consideration. Well, the value was given, so we put in 38,000 and we have the fair value of 125,000. So the fair value is 125,000, and that is what we would debit the investment. So we have an investment in Warsaw that is a debit of 125, and we pay cash. So that would decrease the bank account. So we would book a credit for cash. And the same thing is true for all the other credits here. The share capital will be increased by 10,000, which is the nominal amount, 10,000. And then as we value the 10,000 shares at market at $4, we would value the whole increase of the capital by 40,000. But 10,000 go into the nominal amount, which is the share capital, and the difference, which is the share premium, goes into the premium account. So we would split for that to have one account just showing the share capital, which then can be agreed to the notes or to the official papers that the notary public will hand in to the register. So we have that one, and we have a share premium, which is holding the difference. Then the loan notes, as they were issued at market, they will be there and will be a liability for the company. They have to be paid back. In addition, the interest has to be paid, but that will be cost of the next 2 periods. So we will not take that into account here. With a difference to the deferred consideration, that is a no interest bearing liability. So we have to discount what we have to pay in 2 years' time by 10% for 2 years. So the fair value of the payment in 2 years' time is 16,529. So that is an obligation and will be a liability shown in the books of Poland. Now we're still in the books of Poland, not in the group accounts. All right, so the contingent consideration, I think that was clear. That was given, and when you add that all up, you have a total in credits of 125, which should be the same in debits, otherwise you have made a mistake. Okay, so those were the booking entries. I saw that most of you got that right, but are there questions? Well, if not, then I go to the goodwill for this transaction. I have seen that some of you already answered that question. So that is why we went back into the main call in the main room, and we're discussing it now here. The goodwill from transactions can be calculated off what did Poland pay. So that is the fair value of the investment, 125,000. Is there a non-controlling interest? No, because that would have to be added. So it's nil in that case. And what did Poland get? Well, when we look at the subsidiaries' net assets at acquisition, that was a given. So they paid a fair value of 125,000, and they only got net assets at fair value of 80,000. So obviously they paid too much. And that is called stupid. No, stupidity. No, it's not. It's not. It's hope. It is hope that the fair value of Poland, because they paid 125,000, will increase in the future. So they have more profits, they have more market share, they have other benefits coming from that. So they paid more than just the net assets of that company. So when we compare the fair value of what Poland paid and of what they got when we look at the fair value of the net assets, the difference is 45,000. And that difference is a positive difference. So we call that goodwill. All right, so from this transaction, a goodwill of 45,000 has to be shown in the group accounts. Please make sure we're no longer talking about the single financial statement of the parent. We are talking about the group accounts, because goodwill will only show up in the group accounts, will never be shown in the single financial statements. All right, so what happens to the deferred consideration? As I told you, we have to pay in 2 years' time 20,000. So we have to sorry, we have to calculate the interest, which has to be paid for the 2 years. So we will discount, well, that was the word I was looking for, I'm sorry. We have to discount the 20,000 for 2 periods, and using a discount rate at 10%, which is market, we will discount it to 16,525. That is the number that you have put into the fair value of the investment. So what will happen after or during the year 1 after the acquisition? Well, they have an opening liability balance of 16,000. So they will put a cost of 10% to that balance, which is 10%, or 1,653. So you would debit interest expense, credit deferred consideration. And the closing balance after year 1 is opening plus cost of finance equals the closing balance. So 18,182. You put that to the next year as an opening balance, and then do the same thing. You calculate 10% on the opening balance, which is 1,818. And then, well, what happens after the year 2? Well, in the year 2, they pay the 20,000. So 18,000 plus 1,800 equals 20,000. So when they use the opening balance, increase that opening balance by the interest that they would have to pay, less the 20,000 that they had to pay in the end. So the closing balance will be 0. So over the 2 years following the acquisition, a liability for the deferred consideration has to be shown in the group accounts according to the table above. And that is what is also done in practice. So the controller or the guy responsible for the consolidated financial statements, he or she will calculate the finance cost and then increase any balance that has no interest. Okay, so is there any question regarding this solution? So if that is clear, we can go to the last question. And the last question was, what about if the targets were not met? Well, what does that mean? Well, it would mean that we don't have to pay that contingent consideration. So Poland would be lucky. That's a different form of luckiness, right? So the event does not, will not materialize, and therefore they will not have to pay that contingent consideration. So they have a gain. And this gain of 38,000 can be recorded when they know that they will not have to pay that 38,000. So what would they do? They would debit the liability of 38,000, so debit contingent consideration, and credit income from a, well, what could it be? Could be income from a contingent, income from contingent consideration. So in that case, there will be no correction of the goodwill. Why not? Well, because it is a fact that the contingency did not materialize, and therefore it's not something that is relating to the time when we set up the contingent consideration. It is related to the period afterwards, and therefore a goodwill will not be corrected if there was any goodwill. If, however, and that is the standard is very clear about that, if the 38,000 is a new information and the values that we assumed at the acquisition date were wrong, then the goodwill has to be reduced, because then the gain would relate to the situation, would relate to the facts and circumstances that were there at the acquisition date. And therefore, we have to go back and change the goodwill. But normally, when it relates to the periods after the acquisition, then the goodwill will stay the same. All right. So, any question? No, if not, well, then we could look at other problems that would incur when you have an acquisition or a merger. So what about the legal fees that the investor has to pay to lawyers, to accountants, to the big accounting firms, or similar fees? What would you do with these? And those are no longer defined as cost under IFRS 3, so they would be expenses during the period. So it's a period cost or an expense. Well, what is the reason for that? Can you give me some explanation why? Because in the past, For instance, when you look at IAS 16, you would capitalize the legal fees of a lawyer or an accountant when they helped you to buy some property, plant, and equipment. So you would talk about acquisition cost and would add that to the purchase cost of the fixed assets. So why under IFRS, why does the standard thinks, or the standard setter think, why legal fees of lawyers and associated professional fees for accountants or similar fees should not be seen as acquisition cost under IFRS 3? Can you give me some idea in chat? Well, depreciation has nothing to do with that. So we're talking about the we are talking about the cost that has to be included in the investment. So for instance, when you look at the example of Poland here, when we look at this slide, then we see that the fair value of the investment would be 125,000. So what about some fees that they would have to pay to the accountants? And I think you will agree that this is relating to IAS 16. So they will have a, or no, it's IAS 39, I'm sorry. So this is IFRS 9 now, because they just changed it into a new standard. And there you have the fair value of the investment will not include any acquisition cost. For instance, if Poland used one of the big four companies to help them with finding out what the fair value is, so that fee would not increase the investment. And what is the reason? Well, think about two situations. First, you have a KPMG consultant, and he will charge you $100,000 for calculating the fair value of that investment. So is that increasing the value of the investment by 100,000? Or you go just to a let's say a local joker, which is an accountant which is not working for the big four anymore, and he is a self-made man now, and he will charge the company with 10,000. Okay, so you have the same investment, you have the same numbers, and why would you increase the cost when KPMG calculates that? Why would it be 225,000, whereas when the local joker comes up with the same numbers, it would only be 135,000. So in the end, when that is the fair value, the 125 is the fair value, then when you sell it, what will you get for it? Will you get 225,000 because KPMG calculated that investment, or will you get the fair value of what others are willing to pay? And if 125,000 is the fair value, then why would you get more than that? Okay, so that is the reasoning why we would not include cost of legal fees, lawyers' fees, accountant fees, or similar fees in IFRS when we look at the investment. Well, when you compare that to IAS 16, property, plant, and equipment, I think from my PACC course, you know that acquisition cost will increase the cost for a fixed asset item. So if you use a lawyer in buying some things, you would include the lawyer's fee in the acquisition cost, thus increasing the fixed assets. Is that a contradiction? Yes, it's at the time of IAS 16, the standard setter looked differently at those acquisition costs. So at that time, they would rather increase the value, like in IAS 16, of the item that was purchased. But when they issued IFRS 3, they thought that this cost does not increase the fair value of the investment, and therefore these costs should be not included in the cost for the investment. Okay, so that is well, you can say it's a contradiction. The standard setter would say, well, it's we look now differently on such costs, and maybe in the future they will come back to IAS 16 and change that. But at the moment, it's like we said, it's different. Lawyer fees, accounting fees will be included in IAS 60 valuation, but not included in IFRS 3 valuation, because that is IAS 16 is looking at cost, and IFRS 3 is looking at fair value from the market. So it's two different perspectives that the standard setter took. All right, so that's about professional fees on acquisition. Now, my key messages for this chapter are: an investment in a subsidiary must be recorded at fair value of the consideration. That is the cost. Well, that could be cash paid, shares issued at market value. If they're not issued at market value, you have to change the count for the difference. Same thing for interest-bearing loan notes. If interest is at market rate, you will take the nominal amount of the loan notes. If the interest is under or over the market, the fair value of the notes has to be determined. Deferred consideration, if paid in cash at present value or future cash flows, then if shares are to be issued at market value of the shares at acquisition date. So either market value at acquisition date or present value of future cash flows. Contingent consideration, well, we will have to set up the liability at fair value. And if settled at a different amount, the difference goes to income. The shares will, well, if the contingent consideration is in shares, then the shares have to be valued at market value. And if not issued, there will be no change in equity. So there will be no difference that goes to income. Any professional fees on acquisition are directly expensed to profit and loss. They are not considered to be acquisition cost, as in contrast to IAS 16. The reason for that is that those costs would not increase the fair value of the investment. And I think I made that clear. When you have a local joker or a big four company and the cost is different, it will not increase the value of the investment. All right. So any questions? Well, if not, then I think we can go on. We still have half an hour today, so we will look at the purchase price determination. Well, you know from the PACC course that a positive difference is called goodwill. So when the purchase price is higher than the net assets acquired, the acquirer shall measure the identifiable assets acquired and the liabilities assumed at their acquisition date fair values. So let's have a look at the example. We have a purchase price of 800. So then we look at all the assets that are there in the balance sheet. And we also look at assets that are not sitting on the balance sheet, like a patent that they have self-developed, and maybe they did not value a lot to that patent. So it's maybe the value, the book value is near to zero, but they have identified that asset, and therefore we will have to put a market value to that patent, so fair value, and that would also be included in the identified assets at fair value. So we would look at assets that are sitting already on the balance sheet and put a different value to it, and we would look at assets that are not sitting on the balance sheet but should sit there and also put a fair value to those, and then include those assets in this amount. Then we have to see, well, what kind of liabilities do we assume? So we will have to pay in the future, and not like the purchase price now at present, we have to pay that in the future. So the 300 additionally assumed liabilities will increase the purchase price, but paid later and paid differently. And maybe there is a share of non-controlling interests that would also be added because we have to compare the difference, which we then take with 100% of the assets and liabilities that we will get. So in the net assets acquired is 100% of net assets of the company. The purchase price is only for the part that the investor would acquire from the seller. Okay, so for instance, if you have assume maybe 80%, you have bought 80% of that company, then the share of NCI would represent the other 20%. And if you had bought 80 plus 20%, so you would have to pay 800 plus 60. So that would be the 100%. So that is why you have to deduct the 700, which is 100% of the fair, 100% of the assets, and the liabilities is 100% of the company's liabilities, whereas the purchase price is only for a part, a major part, but only for a part of these net assets. And therefore you have to add the share of the non-controlling interests. So when you make the calculation here, you have a positive difference of 460. And well, we know that is the goodwill. Well, we should check whether we got all the assets and all the liabilities. And then if we're sure that this is the case, we will then record that as a premium in the consolidated financial statements. I think that is clear. We had similar examples in the PACC course. What is new is the share of non-controlling interests, but I think you can easily understand the purchase price is for 80%. And maybe I should make that clear for the next course. So I write that number down. It's 80%, 20 NCI. All right, so the purchase price is for, let's say, 80%. Identified assets and fair values and assumed liabilities is for 100%. So we have to put in the difference with it, which is the share of NCI of 60, and that would increase the purchase price, although the purchase price is not really increased, but it would be same sign, like a plus here. So the difference, when you take into account also the share of NCI, it's 460, and that will be accounted for as a goodwill in the consolidated financial statements. Okay. Questions? Well, if not, you're ready for your next breakout. So please have a look at Jamaica. Jamaica, facts and circumstances, hope are clear. So on 1st December, Jamaica acquired 160 million shares of Kingston Limited. Total shares are 200 million. Purchase price is 450. And now we have some hidden reserves. So not all the assets and all the liabilities are recorded at the fair value. So they have, of course, a book value. And you have to find out the difference, which are called hidden reserves. So the fair value of tangible assets were $120 instead of the book value, which only shows 100. And the fair value of inventories were 210. The book value only shows 200. So the next slide then shows the two separate financial statements of the SFS1 of the two companies after the acquisition. So I have already put that journal entry in to show that the investment was debited and the cash was credited. So what is your requirement? Well, please prepare the separate financial statements for the two companies following the group's accounting principles. So that's FSS2. And then prepare the consolidated financial statement for the group. So you should be in a position to do that in the exam. So please take that serious and work on it and check whether you understand the principles and then come up with the right answers. All right, so I will put you into meeting rooms. Well, I don't know whether there is a lot to correct, because when you get out of the session, you might not be assigned to the right breakout room. So if that happens, please tell me in which group you were, and I will put you there manually. If that does not work, I will send you all to new breakout groups. So let's try the first one first. All right, so welcome back to my lecture. we just worked on the case study Jamaica on page 107, and I would like to explain what we did. I saw in the breakout rooms that yeah, nearly all of you got the right answers, so I'm very pleased what I see. And here are the facts. Well, the first thing you had, these are the separate statements of the financial position after the acquisition. So this financial statement of the parent already shows the investment of 450, and it shows the equity, the net assets of 300 of Kingston when you look at the single financial statement number 1. And obviously these numbers now do not match, and that is near to the practice because, well, obviously Jamaica did not buy 100% of the net assets of the shares of Kingston, but only a part of it. And obviously they paid a goodwill. So these two numbers, they never or rarely, very rarely match with each other. So that is what is in practice. Okay, but nevertheless, when we look at the first question that you had to answer, first was that you should be able to modify Jamaica's and Kingston's local accounts to those accounts that are following the rules of the group. So making from the local accounts, you will change to the group accounts to the package. So we assume that Jamaica already followed the group's instructions. So if that was the case, then this column does not have to be modified. In the case that Jamaica is not preparing its local financial statements in the same way as they would issue their group financial statements, then of course they also would have to change these numbers. But in this case, not. So we only have to deal with Kingston. And when we look at the book values of Kingston, then we have this row. Then we have to increase the hidden reserves. So we will have to increase the 20 here, which is the hidden reserves of the tangibles. We have to increase the hidden reserves in the inventory, showing 120 tangibles and 210 inventory. All the other numbers will stay the same. So the 30 debits go into the total sum here. So they have a total of 530 in assets, and they have a total of 530 in liabilities and equity. So equity also increased by 30. And the reasoning why it would go to retained earnings is that the hidden reserves, if shown already in previous periods, that would have been a profit of that previous period, and therefore as we increase the assets here, we would have to increase retained earnings also just by assuming that those hidden reserves were already earned, and when they were purchased in that moment, they were earned for the old shareholders. So as a result, we have the Kingston SFS2 valued at fair values, whereas in the beginning, we had, when we looked at the local financial statements, or SFS1, these are book values. And well, here we have book values. Well, this is something that might be a little bit disturbing, because now what we will do in the next table, we will add the book values of the parent, because we will not change those numbers to fair values. And we will add those book values with the fair values of the acquired entity. Are we adding apples and bananas? Yes, we are. But that's the standard. The standard says we will not do a fresh start. So a fresh start is the theory that also the book values of the parent will be adjusted to fair value, but that is what the IFRS 3 is not allowing. So IFRS 3 is only related to the valuation of the subsidiary, and all the book values here should be changed into fair values at the end. So the acquisition, the investee, will be valued at fair value. We're not talking about the book values of the parent. The book values of the parent will stay the same. Maybe in future, when they change the standard to the fresh start theory, so when that will be become the more prevalent view of the standard setter, then maybe we would also have to change these numbers to fair values. But at the moment, IFRS 3 is only talking about the subsidiary, and therefore we will only calculate the fair values and make the debits and credits in the financial statement to reflect the fair value of the investee. Okay, questions? No. All right, I think it's 2 o'clock my time, 7 o'clock your time. We've done a lot. I see a lot of exhausted students sitting in front of me. Well, I think we are very good in time, so we can really be proud of what we have achieved. Please be punctual tomorrow. Tomorrow will be Wednesday, so the lesson will only start on 5:30 your time, which is 12:30 my time. And have a nice morning and maybe day. And well, we see each other again at 5:30. Please be punctual, because we will do a poll. So during the poll, I cannot open the door from the waiting room to the main room. So if you decide to be later, okay, then you will be sitting in the waiting room waiting for me to let you in, and that will be after the poll. All right, so I hope you like the course. I hope you have learned a lot, and I will see you again tomorrow. So bye-bye. Bye-bye.